Welcome back, everyone, to our Wednesday 1 o'clock workshop. My name is Brian Martinez. I'm with NuView Trust Company. I'm real excited about our guest speaker today. His name is Joshua Andrews, and the topic we'll be talking about is how to profit on the red-hot performing loan market. So this is going to be great for all you note investors out there. Just before we get started, a few disclaimers. So NuView, we do not provide any tax or legal advice. Always consult with your CPA or attorney. We are an IRA custodian, so our main focus is to custody your investments in your IRAs, education savings accounts, health savings accounts, solo 401ks, and those types of accounts that we can custody. So what is a self-directed IRA? So any of you new listeners out there, a self-directed IRA gives you the ability to choose your own investments. This is outside of the stock market. So you have companies like Fidelity, Charles Schwab, Merrill Lynch, they limit you to stocks, bonds, and mutual funds. Well, here at NuView Trust, our clients invest in what's called alternative assets, which is primarily real estate, mortgage notes, tax liens. You can invest in funds and syndications, any private entities. And you can also invest in cryptocurrency and precious metals. Why would you want to self-direct your IRA? Well, you get the tax savings. It's either going to be tax deferred or tax-free, depending what type of IRA that you're using. You're investing in things that you might already be investing in with your own cash. So why not do it in an IRA, something that you understand? And it's also giving you that true diversification in your retirement portfolio. That's an opportunity to build your wealth. So these are the most common types of plans that clients will use. So you have your personal plans, your traditional IRA, and your Roth IRA. These are the contribution limits. If you're under the age of 50, each year you can contribute $6,000. If you're over the age of 50, there's an additional $1,000 catch-up contribution. Now, the biggest difference in the traditional and the Roth IRA is the way it's taxed. A traditional IRA, you pay the taxes when you take the money out of the retirement account after you reach the age of 59 and a half years old, because it's a tax deferred account. Now the Roth IRA, you're going to pay the taxes now on those contributions, and then it's going to grow tax exempt. When you take that money out after the age 59 and a half, it's going to be tax free for you. So it's really up to you to discuss with your tax planner or whoever helps you create your strategies for building your wealth, which option is best for you. And most clients have both of these accounts and they partner these accounts together. Then you have employer plans. So if you're self-employed, you're eligible for a solo QRP. That's a pretty great plan. It has high contribution limits, up to $61,000 a year you can contribute. And if you're over the age of 50, there's an additional $6,500 you can contribute. And then you have your SEP IRA. Also, you must be self-employed for the SEP IRA. Maximum contribution is also $61,000. There is no catch-up contribution with this plan. If you do have employees, well, there is a mandatory match. So whatever you contribute to your SEP IRA, that same percentage must be matched for those eligible employees in your business. And then simple IRAs, those are common for small businesses. $14,000 is the contribution limit for 2022, with an additional $3,000 catch-up contribution if you're over the age of 50. You have specialty plans as well. So if you're saving up for college for the kids or grandkids, there's an education savings account. This can also be self-directed. The contribution limits are $2,000. It is not tax deductible, but it will be able to be used towards education expenses tax-free. So whether that's college tuition, private school tuition, uniforms, laptops, room and board, any of those things it can be used for. And then you have your health savings account. This is a great plan because it is tax deductible going in and it's tax-free coming out. Not a lot of plans offer that. So you're contributing just for yourself. Your health savings account covers you only. You can contribute $3,650 a year. And if you have a family plan, it's $7,300 a year. So it's not as large as the IRAs or the employer plans, but when you partner these plans together, that gives you the power to grow all of these accounts and really build your wealth in a tax deferred or a tax-free vehicle. All right, so I'm going to go ahead and introduce our guest speaker, Joshua Andrews. He was a speaker at our last investor retreat, which we have another one coming up. Stay tuned. We'll be getting you some more details on that investor retreat. Should be in January, we're hoping for. Josh is with Paper Profits. If you haven't read his book, I highly encourage you to do that. Josh, go ahead and share your screen with us.
We appreciate NuView, and then everyone who's taken the time to, out of their day to sit down and get some education and look at some alternative ways of investing. Is there anything that we need to go over before we start?
No, the floor is all yours, and I'll take over at the end for Q&A.
Okay. Well, again, thank you so much. One of the things that we'd like to start out with is just some disclosures. So first off, we are not registered investment advisors. And so everything that we're going to discuss here is based or meant for educational purposes only. We don't know your specific strategy or where you're at in life with regards to retirement, things that you're comfortable with, et cetera. So take what we're saying today as educational advice. And of course, when you do have questions at the end of this webinar, we'd be happy to talk with you. And then of course, we're going to provide our contact information as well. So if you want to have a follow-up conversation. So very briefly, our company is called Paper Profits. That's our brand. And it's actually named after a book that I authored in 2017. I'm going to give you a link to get a copy of the book free of charge. We ship it out to you. It's an actual physical book if you'd like to read it. It's just educational only. And so there's no selling, there's no pressuring you to do something that might not be right for you. It's just educational information to give you a layman's view snapshot of the note industry and how this might be an asset to kind of feather into your retirement portfolio. Excuse me. So the managers of Paper Profits are myself and then my partner, Jean Wobbs. She's been a wonderful partner. She's actually a CPA, so she has a second pair of eyes on everything we do in addition to our other CPA. This is our contact information, and then I'll also provide this at the end of the presentation as well. So I'll present this at the end, but here's the link if you'd like to get a copy of my book. I definitely recommend it, completely free. You'll just go to the website and essentially fill out, where you'd like the book shipped and to who, and then we'll go ahead and ship it out. Usually takes about a week. So just a really quick background on my story and what we do and kind of how we came to what we're doing now. I began investing in mortgage notes in 2012. And I started kind of by chance. I met some folks that ended up becoming a real mentor to me. And we're still friends to this day. He's actually coming to my wedding here in October. So I started with my own money. I started with IRA money. My first purchase was $18,000 for a performing loan because I studied all I could, I read all I could, and I was trying to figure out, is this real? And everything looks great on paper until you actually see performance, right? You see payments coming in, you see money coming from your investment. That's kind of where the rubber meets the road that, okay, this is a real thing. So that's what I did. And from 2012 to present, I was buying loans from my own portfolio and then helping others do that, bringing in friends and family, and just kind of learning the business myself on my own dime first before we ever brought in any other investors' capital. I think it's really important. So today we have a couple note funds that's all we do. Jane and I, is we specialize in loans, mortgage loans, and we'll talk a little bit about that. We currently manage right around $13 million of investor capital that's currently deployed into performing and then some non-performing assets. And since 2012, I've probably purchased and sold, well over 1,000 loans. We didn't keep all of those, of course. Some of those were in trades where we were just marking them up and moving them on as a broker, but we've been involved in a lot of transactions. So I've seen it all. I've seen, garbage, and I've seen really good stuff and everything in between. And today, and what we've specialized in from the beginning, is residential performing and non-performing loans. And I'll talk a little bit about different types of loans, just to give you a very brief, for the folks here that may not have an understanding of, what a mortgage, what a note is. We're just going to go over those briefly before we get into the performing loan market and how to maximize your gains with that. So what we're going to cover today is some basic loan terminology. like I mentioned, for those who may not quite be up to speed, I'm just going to try to keep it very basic so it makes sense, because this is really not a complex topic. At the end of the day, it's very basic. It's not rocket science, but there are some fundamental things that I think is important to understand going into it. So we'll talk about that really briefly. We're going to talk about the basics of how a note and mortgage works for the lender. So what's in it for you as the investor? How does that benefit you and provide security for your NuView retirement funds? And then we're going to talk a little bit about performing and reperforming loans and what the difference between that terminology is, what that really means, what it costs to buy these types of assets. Now, it's all over the board, but we'll kind of get into that a little bit more, and I'll show you how to value those kind of at a 30,000-foot view. And then how much can you expect to make? How much yield or return would this produce for you as an investor? Because as investors, we're always comparing anything new that we might see against what we currently know and feel comfortable with, and also the risk. So there are some things that have extremely high returns, but the risk of losing part or all of your capital is very high. And so, those aren't things that we're going to put our entire life savings into, because it's just not a smart move. So part of this comes into diversification. I'm a very big believer in diversifying your investments. And as we're seeing now in a lot of things that are unfolding in the current marketplace and economy, it's even more important to make sure that you're well diversified in many non-correlated asset classes. So something goes wrong here, it's not affecting here. And so you have fallback, right? It's not wiping out your entire nest egg. How to maximize the value of performing loans. Now that's a very important thing. And some people, it's very basic, but a lot of sellers or even buyers don't quite understand. So I'm just going to go over some of the basic things that we've learned in our transactions to maximize that if you're a seller, right? Because you might buy loans and in the future decide to sell it. Maybe the time is right to harvest some gains from it, some profit, or maybe you need the cash for a life event or to go into another investment. So knowing how to position that asset and buy it originally correctly is really important. I'm going to talk briefly about that. And then I'm going to talk about some of the keys that we've learned to creating a really successful portfolio of performing loans. Now, portfolio, of course, is more than one. So we'll talk a little bit about what the advantages of that are, and if it's right for you or if it even makes sense. And then we're going to talk about a little bit about what we do in our company, how to leverage experts like ourselves or others. I mean, there's a lot of other companies out there as well, to leverage people that just do this all day long to accelerate your retirement, your NuView retirement balance. Okay, so let me get a drink of water here, and then we'll just talk really quickly about some of the basics of notes and mortgages. So notes and mortgages, for those of us who don't know the details on it, really are pretty basic. So a note really is an IOU that outlines the terms of the loan. So whether this was a loan that was originated or created by a bank or a private lender, a note just is a promise to pay, and it specifies the details of if there's interest, when the final payment's due, how much was borrowed and owed, et cetera, and the time frame of when things are supposed to be handled. So that's the note. It's not a security instrument. It's just literally an IOU. The mortgage or deed of trust, depending on the state, is going to be the security instrument. So that is going to go on title against the property, real property. And in our case, it's going to be residential property in the US. Someone's home, like someone like you and I who has a mortgage, very exact same thing. And that's going to be on title to secure our interest as the lender. So you've got the two pieces. You've got the note, and then you've got the mortgage. Now the note's not recorded, typically, only the mortgage, the security instrument. And what that does is that gives you legal right to, if the borrower stops paying or defaults per the terms of the mortgage and note, you can actually start foreclosure, or you can move forward legally in a legal manner to satisfy or sell the property or get your money back. So that's the idea behind that. And that's where the security comes from, right? So you have something to go take, which we don't want to do that, but it provides security. So we'll talk about briefly here a little bit about the types of notes and some of the basic terms. So first lien, well, basically you'll hear terms like first lien, second lien, third lien, junior lien, HOA lien, tax lien. A lien is just a claim against the property, a monetary claim, and that's going to be recorded against title. So if you pull the title report, it should show on there who's owed, when the claim was put on against the property, etc. What designates a first lien, second lien, third lien, etc., is the time that it was recorded, so the recording date. And that's super important because basically on a liquidation, so let's say the property is being sold by any of the lenders, the first lien needs to be paid first, then the second lien if there's proceeds left over after paying the first, and then on down the line if there's other liens. Now, there are situations in certain states where, let's say you have a condo complex and they've got an HOA lien or something like that. Well, in a lot of states, the HOA liens trump senior liens. So even if there's a senior mortgage on the property, if this person is not paid their HOA in 5 years, they're going to put a lien against the property. They typically don't foreclose, but it is what's called basically a senior lien. It's above the actual senior. So in some cases, you have to be careful and just do your due diligence on that. Those are municipal liens, water, power, sewer, things like that. Talking about the term performing. So performing just means that it's paying, right? So it's a normal mortgage. It's just paying per the terms of the note and mortgage. Everything's fine. Non-performing means it stopped paying. Now, typically, there's a little bit of a gray area here. So you have performing, and then you have kind of in default, right? And that's where the borrower is 30, 60, 90 days late, right? So they can be basically 2 months late and then pay in full and then do that again over and over. And there's nothing you can really do about that. That's more of a delinquent status. Non-performing is really after it's gone to 120 days late, where after 120 days, you can actually begin collection, hire an attorney, start the foreclosure process, things like that against the property. Now that's very rare. It does happen, but if you're buying right and being very cautious and doing your due diligence, it's not a common occurrence where you have to go through that. Because most folks want to keep their home. They're not trying to just be deadbeats. Reperforming means that you had a non-performing asset. Maybe they hadn't paid in 2 or 3 years or however long. And then you came to them and either they caught up, so they reinstated the loan. So reinstatement would be, let's say they haven't paid for 6 months. And so all those missed payments plus interest for that 6 months to present, they would just make that lump sum payment. Maybe it's $8,000 or $10,000, whatever it is. And now they're current and they just keep making their monthly payment. So that's a reinstatement. If they're fully delinquent and it's just non-performing and they don't reinstate, then a lot of times what firms like ours and others do is we'll do a modification with them. So modification is restating the terms of the loan. So it's a whole new set of documents. Our security instrument, so the mortgage or deed of trust, is still on title. We are just redoing the note, essentially, the terms. And that's very effective because you can work with the borrower. Maybe one of them have lost their job and they still want to stay and pay. They just can't catch up that 6 or 8 or 12 months of missed payments, but they can make their normal mortgage payment. So you restructure the loan and then they start paying normally moving forward. Now that's basically a reperforming asset. So there is some risk, of course, in there because the borrower has defaulted in the past. So you have to look at that on a case-by-case basis and make sure that, is this person just a deadbeat, or, like we've seen over the last couple of years, you can lose your job. You may not be able to get to work. There's a lot of different things at play. So we need to understand what that is prior to, just buying reperforming loans. But reperforming assets, solid ones with good equity, are very profitable. They're very solid, and we buy both. So we buy performing loans and reperforming loans. And then, of course, there's a lot of other different types of asset classes. This is not the only loan type that you can invest in. I mean, I have a colleague who does medical debt, and there's commercial, multifamily, there's auto loans, there's credit card debt. And as you kind of go down the tiers, some of them are less attractive because they're less secured. So some of this is really going to depend on your risk tolerance, where you're at in life, and how much of this investment is really a major part of your retirement portfolio. So those are things to consider. And then we'll just briefly touch on why I believe that notes can be a superior cash flow investment. So notes offer, the right notes offer very good safety with regards to real estate. So you're still involved in real estate, but you're not as much worried about these wild upswings or downswings with, equity per se. You are worried about equity, but you're not involved in buying and selling this thing. It's someone's home. They have their kids in school, they have a job, they have all this stuff, they have roots in the community. And so this is a way to have something that's secured by real estate, but without a lot of the hassles as far as like having a rental property. Another thing that I really like about notes is, and this got me really excited early on when I first started studying about notes, is they're discounted. So what discounting means, let's say, just a really crude example, let's say the borrower owes $100,000 and their interest rate is 7%, right? It's a 30-year fixed loan, 7%, they owe 100 grand. Whoever owns that loan right now wants to sell it, doesn't matter why. And I need to get a certain yield. So let's say I need to get 8 or 10%. Well, I can't pay a full $100,000 for that because the borrower is only paying 7. So if I bought it for 100% of the unpaid balance, which is called par, buying it at par, you'd basically be making 7%, right? Which is not bad. However, typically in most transactions, you're buying it at a discount. So I might buy that loan at, the borrower owes 80, we might buy that for, I'm sorry, the borrower owes 100, we might buy that for 80,000. So there's a $20,000 delta there where, the borrower owes 20,000 more than we actually bought, right? Or what we spent to buy the loan. So what that does is that increases your yield internally, and we'll talk about that here in a little bit. But it also gives you a little bit of extra because occasionally borrowers pay off. So you might have this for 4 or 5 years, the borrower refinances, maybe they have to move because of a job, sell the house. Well, they still might owe 90 grand on it or 100 grand, depending on when they pay off. So what that's going to do for you is you bought it for 80, you're getting your yield. If they never pay off, you're getting the yield you wanted. And if they do pay off, you're making an extra 20 grand. So that does happen. There's really no way that we found to kind of coordinate that. So it just kind of happens organically. You can't force folks to refinance or sell. I mean, you can try to incentivize them, but we found that's largely ineffective. So that's a nice thing that I like. It's largely a passive investment. So performing loans, typically what you're going to do is you're going to, the heavy lifting or the work is your due diligence, finding it, negotiating with the seller for the price you need that you can both agree on, and then the due diligence. So the due diligence means you're going to do a whole bunch of different steps to make sure that this loan is really what you think it is, that it's secured, that the borrower's who they say they are, etc. So you feel comfortable with it, right? So you don't have to have this in the back of your mind and that you're worried about it. You can just buy it, kind of set it and forget it. Now, there is some work that's involved. You have to find a servicer. We use a licensed servicers to basically handle the loan. So we'll buy it, put it with a servicer, and the servicer is the face to the borrower, right? So they're going to send out statements, they're going to accept payments, etc. And then at the end of the month, or once every couple months, they're going to send us the money. And of course, they charge a fee for this, and they do a lot of things that you would not want to do on your own, just for liability reasons. And it's paperwork, it's busy work. So essentially you'll buy them and then put them with the servicer. And really what this boils down to is very consistent payments, typically. Not always. You're going to have some borrowers that have issues, but in general, if you select these right and really take your time, you're going to end up with a portfolio of loans that secured by real estate, good properties in good areas, plenty of equity, right? So you feel okay if things fall apart, you can go foreclose and sell these properties, get your money back, maybe make money. And you're just basically getting checks from the servicer every month. So there's a little bit more to it if you have a large portfolio, of course, but that's really it. I mean, it is very, very simple without the hassles. So what are the risks? We all like talking about how great everything is. There's always a downside to everything. So this included every investment, every venture. Some of the risks, the top risks are, of course, the borrower could stop paying, right? So something could happen, they stop paying. Typically, what we've found is the reason that they do that is going to be death, divorce, job loss. They're ill, they're on disability. Something has happened where they just can't pay anymore, right? They don't just wake up one morning and say, oh, I just don't want to pay my mortgage. Something's happened. And so finding that out is helpful because it might be just a temporary bump or blip on the radar where, hey, I can't pay my mortgage for a couple months. Or it might be, my husband's in the hospital with a heart condition. I don't think we're ever going to be able to pay. And so that's a whole nother conversation. So the risk is they don't pay, right? And what you want to be aware of is what is the property worth? And is there enough equity, meaning the difference between the property value and the loan that you've purchased, to where if you're not able to work anything else out, like you've exhausted every other avenue, could you hire an attorney? Could you go through the normal foreclosure process legally to sell the house, have someone help you do that, and then exit, sell the property, rent it, do whatever you can to collect your money or make additional money? So that's really the risk. There are some other small risks, meaning if you haven't done due diligence well, which is a key step. If you have not done due diligence well, meaning pulled title, had maybe a second pair of eyes on it before you purchase this loan, have somebody that's in the industry that you trust or a mentor say, hey, I've got all the information here from the seller, everything looks good. Could you take a look at it for me? The risks are a lot of it is just rushing in, thinking it's a good deal, just looking at the yield and going, okay, I'm going to buy it. So you want to take your time, make sure that you really understand what you are buying. And then what does it cost to buy them? What do these look like, and how do you calculate yield or your return, right? So it really depends, but I can give you some guidance on that. You always want to buy on yield. Now, yield's going to be a little bit different. We talked about discount. I've had a lot of earlier or maybe beginner investors really fixated on the discount. And that's good if you know that, hey, the borrower has a very high likelihood of paying off soon, because then you're going to get that spread, right? Like in our example of 100 grand, you pay 80, for sure by some means that maybe the borrower has gotten a job offer somewhere else and they're going to take it and sell their house. Well, then you can pay, you're focused on the discount. But typically we're looking at buying these loans, putting them in our portfolio and forgetting about them, right? Just making sure that the money's coming in every month from the servicer. So what we're buying these at and what you want to focus on is the yield. Now, yield's a little bit different than the interest rate. Yield takes into account the time value of money, how often you receive the payments, what those payments are, the interest rate on the loan, whether it's amortizing, interest only, if there's a balloon to it, when the final due date is. So all of those factors. And so typically when you're calculating yield, we use some software here that's called time value. It's T-value, and I've got a link right here. I highly recommend this software. It's very inexpensive. I think it's like $100. They're always doing upgrades. And essentially what it is you just put in some details and you ask it what price I should pay for this loan. So if you know, hey, I want to make 8 or 9% on a really good loan that I feel comfortable with, you're going to put all the information in and it's going to spit out your exact purchase price. And you can do a whole bunch of other really, really cool stuff with it that's useful to investors. So I would highly recommend that. They have training, all kinds of things. It's a really, really good product. But that's what we use to calculate yield, because just looking at it on face value is not enough. It's not going to tell you really what your return is. So focus on that. Don't get distracted on the discount. Discount's important. It plays into the yield calculation, but a lot of other things play into yield. So that's what you want to buy on, and that's also what you want to sell on, typically. And there are exceptions to that, but we'll talk a little bit about selling as well. So what do these look like? They're all over the map. I mean, it just depends on how much money you have. And, you know, there are jumbo loans, $2, $3, $4 million for somebody's house. And then there are small loans, you know, something in Michigan, you know, might be middle of nowhere, and it might be a loan that's $56,000, right? So it's all over. What's most important is that you're comfortable with the asset that's securing the loan. You're comfortable with the payment or the history that is presented to you, and a number of other factors when you're buying in your due diligence. And that could be a whole nother presentation, which I'm happy to do at a later time, about due diligence and kind of what we do, the steps we take to verify everything prior to purchasing anything. So here's an example of a loan we just sold this week. Now, the property fair market value was $255,000. That's over here on the left side. And how we determined that, we didn't just guess, we didn't go to Zillow. We actually paid for a BPO, which is a broker price opinion. It's similar to an appraisal, but because this is a loan, we can't go inside the house. So we don't know the inside. We can just do a BPO, which is very similar. And that came back at $255. There's comparable properties, et cetera. So this loan has an interest. It's a senior lien. It's the only lien on the property. There's an interest-bearing UPB, or principal balance, of $171,000 and change. And then there's a deferred unpaid balance of about $102,000. Now, deferred simply means it's still owed, but it's not generating interest. So it's not, you know, generating interest against the borrower, but it will have to be paid someday. And the way I look at these kinds of things is, this is a 30-year fixed loan. They have another 300 payments left. So you're really not going to collect that 102 until, you know, this person dies and sells the property or pays it off. You know, this borrower's been there for a long time, and I don't see that happening. So you will collect it, but it's when that time value of money comes into it again. It's very important. The money is great, but if you collect it 40 years from now, you know, the value of that's really not going to be a whole lot for you. So typically what a seller and a buyer is going to focus on something like this is they're going to look at the interest-bearing UPB. Now, the deferred still matters. And one way that it would matter a lot is if the if the date or the maturity date, which is the date that the borrower needs to pay the whole loan in full, if that maturity date is like 5 years from now, I know that I'm going to collect that extra 102 in 5 years because that borrower is either going to refinance with me or we're going to sell the house. We're going to figure something out. But in this case, it's so far out. You can see that the maturity date at the top is 2048. That 102 almost doesn't factor in, as crazy as that sounds, it almost doesn't factor into the cost or the price when you're selling this. And not all loans have that. I mean, most just have the UPB, and that's all you're looking at. So on here, you can see the property's worth 255, interest-bearing unpaid balance 171. We've got the deferred, and then we have a sales price, which we actually sold this property or the loan for to another buyer who's just going to keep it and collect the yield, is 160,000. And so for us, you look at, we did calculations on the back end, and the buyer is getting a yield of about 8.3. So that's his yield. Now, keep in mind, yield is calculated as if you receive that entire payment stream. So it's not counting in like an early payoff, something beneficial like that, because we just don't know that's going to happen. So the yield of 8.3 really is saying, if the borrower just keeps paying normally every month until the maturity date, 2048, that's going to be my yield. Now, it's going to be a little bit higher simply because there is deferred UPB, but not as much as you'd think because it's so far out in time. Now, where this buyer would really win is we sell the loan, and then, for some reason, they sell the house. Well, then he's going to collect the difference from the deferred UPB to the property value. So in other words, you have 255 grand, you've got the interest bearing plus whatever it is up to probably the property value they're going to collect. So there's a lot in there that he could actually benefit from. But for us, we're making money based on our figures, and so we're selling it and moving on. So that's what a normal, very vanilla transaction looks like. Normally, they just don't have the deferred part because that starts to get a little confusing. So what yields can you get for yourself as an investor for your NuView IRA account? What does that look like? Well, it depends on how sophisticated you are and what kind of connections, and if you've been doing this for a long time. We've been doing it for quite a long time, and so we obviously have a lot of colleagues and business connections and sellers that know us, that we've done transactions with. So it's very easy for us to say, in general, this is what we can get on the open market. Somebody just coming into this, it's certainly doable, but it would take a considerable amount of work and just networking and a little bit of trial and error. But most folks, what I've found, have a certain kind of comfort level with loans, how much equity coverage, where it's at, house needs to be nice and pretty, things like that. So what you're going to see in those situations, typically, not always, there's always exceptions, is going to be around 8 to 10% yield per annum or per year for the average investor. Now, if you want to buy riskier loans, and what I mean by riskier is not ones that are necessarily going to default, but maybe thinner on equity, the borrower doesn't pay on time, he misses 2 months and then pays again, brings it current, and kind of repeats that cycle. That's a spotty pay loan, basically, or scratch and dent, sometimes they call it. You can get higher yields, right? Because there's more risk there because you're not getting payments as consistently. And also it shows that the borrower is maybe less than dedicated to paying their bills. So you can get in that 11, 14 range, but in general, most of what I've seen, working with investors, the types of properties that they're comfortable with is really going to be that 8 and 10 range. And then with retirement funds, this really depends. So everybody has a little bit different kind of mindset or where you're at in life. Some folks we work with, they've got another 5 years and then they're going to retire. So that is important to know for them. versus someone who, hey, I've got another 10, 15 years plus, and I just want this thing to roll over and grow. Well, obviously, the longer time you have, the better, because you're going to be able to compound those earnings. And I think that's one of the strong suits of notes in general, is that it's a very linear, consistent for the most part, right? So you might buy 10 loans and have one stop paying, literally. And so you can chart out, if you like spreadsheets and things like I do, you can chart out and be like, okay, so how many of these do I need to buy to reach retirement or reach this stage, right? And of course, you're going to have other investments from other things in your NuView account, but this is one of those things that you can kind of chart and say, okay, is this going to work or not? So with retirement funds, if you have enough time, slow and steady is the best. Don't try to shoot for the moon. Try to get something that's secure, that you feel good about, that you understand, and let that compound, right? So you'll get some cash coming in every month or every quarter or however often. And then once you have enough, redeploy it and continue to do that. And it will slowly start to, of course, compound. So that's the best method that I could recommend with a retirement account. Now, there's other methods with LLC or cash money and things like that. But of course, this is centered around retirement. So now we're going to switch gears slightly, and we're just going to talk about how to maximize the value of a performing loan. Now, this is something to be aware of when you're buying and also if you're selling. So you might think, well, I don't ever plan on selling or, selling loans. It could be a situation where maybe you buy loans and for whatever reason, unforeseen in the future, you want to sell. Could be the borrower is a pain in the butt. Could be you need cash for whatever reason. Could be a life event. Could be maybe you found a much better deal and you need to get that cash, recover, make a little profit, move on into another investment. Or it could be a situation like right now, where pricing for these types of loans is very competitive. There's a lot of money chasing performing assets like this, and so they get bid up. So how you maximize as a seller, so like what we do, is it's important to, of course, sell at the right time. There's times if the market's dead or there's just a glut of inventory, loans for sale, and too few money chasing it, then of course, prices are going to go down, supply and demand. That has not been the case for the last couple of years. I don't see that, in the near future, but it could. But what you want to do is sell at the right time and also make sure that you have enough seasoning. So what that means is that the borrower payment history, if they just started paying last month, like it was a non-performer, now it's a performer, you got it performing again, or they just reinstated, give it 5 or 6 months. So you can show your buyer, your prospective buyer, hey, this person reinstated and they've been paying like clockwork the last 6 months. This thing is gold, right? So that's important because that's going to play into the confidence of that buyer. They're going to feel much more confident about, okay, this thing's back on track. I feel good about it. I can pay you more. And then providing potential sellers a clean due diligence package. And what I mean by that is put yourself in a buyer's shoes where if you're going to buy a loan, you want to know everything there is to know about this thing, right? And, we're not going so far as to go on Facebook and things like that. We're worried about the important stuff. And those are things like the note and mortgage, which is the collateral, the physical documents. What do those look like? Are they matching what this borrower, is supposed to be the borrower? Are the numbers and dates and everything matching? What does the pay history look like we talked about? What does the servicing comments look like? All of these things you want to package together so you can give a fresh title, give everything just nice to your potential buyer and say, there it is, right? It just makes it so much easier and you're much more likely to get a much higher price because they're not wary of anything. You're just being super transparent with them and saying, look, this is why we're selling. This is nothing wrong with this loan. Here's everything you need to know about it, everything that we know about it, right? So that's important. If you're modifying loans, one thing that we found that's very important is modify them with decently high interest rates. Now, I don't mean, try to put this borrower in a bad situation. We're not out to do that. What I do mean is the interest rate that the borrower is paying, or what's called the face value on the note, really plays into your ultimate sale price. So you may not want to sell it. You may never plan on selling it. But like I said, if you ever do need to sell it, if you modify a loan and you're like, oh, I'm just going to give them a 2 or 3% interest rate, you're going to take like a 50% discount when you sell that loan. So, a rough example, if they owe 100 grand, you're going to sell that thing for 50 grand instead of 80. So there's a huge delta there that you need to think about if you are creating or modifying loans. So something that's better would be 6, 7, 8, if it's a very small loan and they can afford it, 9% interest rate, because then you don't have that far to go for this potential buyer to make their yield, right? They only need a very small discount typically. So that's something to really keep in mind. Also, if you are modifying loans, try not to do deferred stuff like we saw in that last loan. We didn't have a choice on that one. But if you can possibly, don't defer or defer large non-interest bearing balances way in the future, because that money essentially is almost lost unless they refi or sell early, because it's so far out in the future. It's like, 30 years is just, it's a long time. And then if you are selling something, get multiple bids. So if you ever decide to sell a loan, put it out on the open market, find a broker that you trust, get multiple bids, have everybody and their brother bid on it and give them a time. Say, hey, here's what I got for sale. I need a bid by next week, whatever time and date, and see what comes back. Sometimes you're really surprised. I'm still surprised with some of the bids. Some are way off of what I thought. I thought it was going to be worth way more. And then others, people are what I would consider overpaying, but they're super happy. So getting multiple bids is extremely important when you're selling. And then nearing the end here, we got a handful of more slides, but some of the keys to creating a successful portfolio of performing loans. A portfolio is obviously more than one loan. Kind of a general thought process with investing is to be diversified. We always hear that, be diversified, be diversified. Well, some of that has to do with being in totally non-correlated asset classes. So if you have real estate, you've got notes, maybe you're buying shares of a stock or physical, gold or whatever else in your NuView IRA. If you're buying notes, one of the ways you can diversify and put together a very clean, solid portfolio is to make sure that you have different geographic areas. So you don't have all your loans in one town in California. You don't, in fact, have all your loans in one state. You have them spread out. So that protects you from state-specific issues, maybe licensing, maybe a disaster, natural disaster, a whole bunch of things. So that's important. You also want to make sure that you have enough equity to feel comfortable taking the property back. And it's going to be super rare that you do that. Of course, if you have many dozens of loans, you will. But in general, most people, it's going to be extremely rare or non-existent. But you want to know that. You want to not have this nagging feeling in the back of my mind that, if they stop paying, I'm in trouble. I could lose a bunch of money. And you want to pay attention to state laws. So there's a lot of states right now, and I think this is kind of the trend for the foreseeable future with licensing. So even in some states require, even if you're just holding a loan in your portfolio and you're doing nothing with it, the servicer's handling all of it, some states are requiring you to be licensed. And I'm really not sure how that works with IRA, because the IRA is a separate entity, right? So I don't know if you actually license your IRA account or if you're licensed, your LLC or personally. So that's kind of a sticky mess that you want to be aware of. Not all states, a lot of states you don't need to be, but there are some that are increasingly asking you to be licensed. So it's something to be aware of. And then, like I said, when you're buying loans, make sure that you're buying stuff that you feel comfortable about, but that you can also easily sell. You may never have any plan on selling ever, and you may not need to. But if you ever need to, you want to make sure that, hey, this is a saleable loan. This is something that everybody else would want, or most people would want, and I could sell it quickly. So price is going to depend on, when you sell it, how much is owed at the time, things like that. But if you're buying something that's really beat up, like you're buying something that's just really beat up to get a higher yield, okay, great. So you got a higher yield, and 3 years from now you need to sell it. Well, it's going to be difficult because you're going to have to try to push this beat up loan on someone else, and typically buyers are going to be pretty savvy. So you may not get the experience that you really want out of it, as opposed to if you got something that's more modest, but just real steady, that literally you could sell over a weekend. And we do that. In fact, a lot of times really clean loans, we'll post it out and we'll have it sold in 3 days, the entire transaction, funding, everything. So that's the kind of loan you want to buy, because you have peace of mind. You can exit pretty much at any time. It's very liquid. And then of course, if you have a large enough portfolio, you want to proactively monitor things. And how you would do that is you have a servicer login where you can, type in your credentials and go see the loan or loans that you have, and, just see if they're current, if there's issues, kind of what's going on with that. So if your portfolio is large enough, that's something you'd probably want to do, I would say, at least on a monthly basis, because there could be some work that you have to do on it. So those are some of the keys to put together a portfolio. And of course, depending if you're dealing with millions of dollars, or something very unique, there's going to be other considerations as well to diversify. So what I want to talk about here briefly, a little bit before we close, is a little bit about what we do with our performing fund, and explain what I believe to be some of the advantages for investors. Now, this is, of course, it's not going to be for all investors. Some folks are just fine doing what they're doing, or maybe, this is not a great fit for them. We do have a lot of NuView investors, which we're doing very well with. And so I want to share this with you. So we have an income fund. It's called Paper Profits Income Fund. And we're statewide. So that means that we buy performing loans only, pretty much in every state. I think there's 3 or 4 states that we don't right now due to some regulatory issues. But I looked before this webinar today, I looked at our portfolio, and we have loans in 16 states right now. So obviously not all states, but we have loans in 16 states, performing loans. So what this does, this income fund essentially raises capital from investors, can accept IRA funds, and basically it's fractionalized ownership of an entire portfolio. So it's a regular private placement investment. It pays investors 8.5% annually. Investors are paid monthly. So, they can compound their earnings, or they can, we can just deposit the money into their NuView account. It does have audited financials. We're in the process of completing audited financials for it. So we don't have it to show today, but we will probably, I don't know, I would say in a couple months, by a third-party CPA. And it's a completely passive investment. So in other words, we're doing all the work, all the management, all the oversight, all of the day-to-day tending of this. And essentially, investors are just receiving a check every month. This is very much kind of like a high interest savings account. Now, of course, it's not a checking account, but what makes it really good is it's 8.5%, and you can kind of come and go as you please. You're not locked in for years. Our lock-in is 12 months, which is 1 year. Used to be 2. A lot of funds will have you kind of locked in, meaning you can't withdraw your investment for a long period of time. So what we wanted to do was, because things are changing, because the market's changing, there could be some really good deals in different asset classes in the future as the economy kind of does its thing. So we wanted to offer the opportunity to investors. It's like, hey, if you have money to park, you can park it here for as long as you'd like, receive your return. If you want to withdraw it after 12 months, there's no strings attached. It's very easy to do that. One of the cool things about this is this allows folks to use compound interest to your advantage. And I've got a link here. It's actually very simple, but it's to calculator.net. I was looking at this and they actually have some really cool stuff. I did a projection, just for 50,000, 8.5% for 3 years, 5 years, and 10 years. And what that ends up being is, so we offer a reinvestment option. So reinvestment is essentially if you wanted, and you can opt in and out anytime, you don't have to do it. We can send every month we can deposit money to your NuView IRA, or you can reinvest it and leave it in the income fund. Well, what happens with that is, it compounds, but of course it takes time to do that. So at 8.5%, 3 years turns into 9.24 cumulative. 5 years, of course, 10%, and then 10 years at 12%. So obviously these are much longer periods of time than most folks are wanting to commit to. But I just wanted to show that you really can gain some leverage with that and still have that liquidity, still have that where, hey, something changes. I don't need to come up with an explanation. You don't need to tell us what, you want out, we cash you out. So it's a really nice way to kind of take advantage of the same type of yields that most people would get if they went out and found loans themselves. Now, I'm not saying everybody, some folks are very sophisticated. If you have a business that's around this, of course, you may be able to do much better. This is for the folks that don't want to make a second job out of it, right? So that's something I wanted to share with you. And then, of course, this fund does require investors to be accredited. So that is one thing to be aware of, accreditation. We do have, if you're not accredited, we do have another fund that you could talk with us offline, just contact us, and we can share the details of that one as well. But this one here does require accreditation. And again, before we wrap up, I just want to let you know that if you don't have a copy of my book, please get it. I mean, if it's of interest, we're happy to ship it out to you. And then after you read it, I think you'll get a much better grasp on just this industry in general, the opportunity, and get a good feeling if this is something that is of interest to you and your portfolio and your investing style, or maybe it's not. There's a lot of stuff out there. We're not the only company out there, but I think this is a very good educational tool and it's totally free. And so here's our contact info. If you have any questions, I'd be happy to answer them. And then feel free to reach out to myself or Jane. Our website's on there as well. We'd be happy to talk with you, even if it's just learning, education questions. That's what we do.
Awesome, Josh. Thank you so much for that information. Yeah, you made a lot of good points and there's a lot to learn. Definitely take a look at that book. I read the book and it helped me get a full spectrum of how note investing works if you're new to this. If you're an avid note investor, there's always more to learn. The market's always evolving. There's so many different strategies you can take. So we're going to go ahead and open it up for Q&A. If you guys have any questions, go ahead and type those in the chat or the question and answer section, and I will read those off for you. There were a few questions as you were presenting. I know Jane answered quite a few, but I'm going to read them out anyways. See if you want to add anything to it. So in a modifying loan, do you typically increase interest rates for increased risk?
For increased risk. So it depends. Essentially, what we're looking at is we typically, not always, but most always, get what's called a loan package from the borrower. So in other words, once we reach the point where they're interested, we will get some financials from them, meaning we're just not going to slap a number to it. We kind of want to figure out what they can afford. Because first, it's unfair to try to saddle somebody with something that's not going to stick or last. But again, it's really hard to tell unless you have financials or tax returns or something to kind of verify, is going through all this modification really going to stick? So we'll request that from them first, review it, and then we'll put together usually 3 modification options that they can pick from. And then with varying down payments and correlated interest rates and terms. And then we'll have a discounted payoff option, which is, maybe we're owed 100 grand, we'll accept a full payoff of 80, within the next 30 days to wipe everything clean. So we do put our best foot forward to do that. But our goal, like I said, is a lot of these loans to modify, we're going to resell. And so it's very important to be cognizant of the rate that we're attaching to these, because it greatly affects resale value.
Okay. What are typical servicer fees, and are there any other fees?
So servicer fees, if it's just a really vanilla loan, 15 to 30 bucks, like Jane had mentioned. If there is escrow and some other things, it could be a little bit more. If the loan or the borrower enters bankruptcy, it could be as high as $95 a month. So it just depends. But in general, for what we're talking about here today, 15 to 30 bucks per month per loan.
Okay. Let's see. Can you go over the accreditation again?
Yeah. So you mean what is accreditation, or just the funds in general?
Yeah, it sounds, I think they said they missed it when you were talking about you have to be an accredited investor, or what was the other alternative?
Yeah, so we have 2 funds. We have the Paper Profits Fund, and which does non-performing assets. And then we have the Paper Profits Income Fund, which is what we've talked about today, which is just performing loans. So the income fund, investors need to be accredited for that fund. If there are investors interested that are not accredited, we do have, like I said, the other fund, but we would just need to kind of talk to them offline and see if it's a good fit. Yeah.
Okay. Are solo 401ks able to invest in the funds?
Yes. Yep. I mean, as long as you have like a checkbook, or you're able to invest in alternative type of assets, yeah. Mm-hmm.
And what's the minimum?
The minimum for both funds is 50,000. We have had some clients where, I know IRA are tricky because, maybe I've got 37.5 in there or something that's available. We'll work with folks on that, but in general, we kind of want to be in that, close to 50 mark. But if we're 5 or 10 grand away from that, we're happy to accommodate. Yeah.
Okay. Awesome. Okay. So the question before is, what exactly does it take to become accredited?
I'll have to look. I believe, according to my memory, it's $250,000 a year income, single, if you're single, or if you're married, filing jointly, I think it's 300,000 together. And then I think it's, or $1 million net worth, excluding your principal residence.
Yeah, that sounds about right. So that would make you an accredited investor. Then you're able to invest into the fund. And there's a lot of companies that require you to be accredited. Typically, if it's a 506c filing, you do need to be an accredited investor.
And that's what we are with the income fund. That's exactly right. So we don't actually go and verify it. So we're not going to look at your, tax returns and all that, but we do have a form that we ask you to fill out, or we ask, we ask someone else to verify it. So your CPA, an attorney. There's also some services, some paid services. You can do that as well, where they'll sign off on it, review your stuff. Yeah.
Once again, you can contact Josh or Jane. It's easy to reach them. Jane at paperprofitsinvestors.com or Josh at notableinvestors.com. If you have questions on self-directed IRAs, I'm happy to help you with that. You can reach me at IRA specialists at NuViewTrust.com. That's the best way to reach me. Either myself or someone on my team will be able to get right back to you. We can set up a one-on-one consultation. They are free. Stay tuned to our social media. You can follow us on YouTube, Facebook, LinkedIn, or you can go to our website, NuViewTrust.com, scan the QR code so you can stay up to date on upcoming classes or our investor retreat. Any other questions, like I said, reach out to Josh, Jane, or myself. I look forward to having you guys again actually, there will not be a class next Wednesday because of the holiday week. The following week is when we'll return. It will be Wednesday at 1 p.m. Thanks again, Josh and Jane, for joining us. I appreciate you guys. You always are a wealth of knowledge. I know the clients and viewers always appreciate hearing from you. Have a wonderful rest of your day, everyone, and we'll see you soon. Bye-bye.
Thank you. We appreciate you as well. All right.